Hello friends, I hope you're enjoying my videos and they are adding to your knowledge and adding to your journey as profitable traders. Well, a lot of you have told me in the comment segment, in via emails, via my WhatsApp number and on social media direct messages that they want me to basically provide more trading systems, trading methods, and why am I keeping back my statistical work away from my online family? Well, there's nothing so secretive about it, and since you want it, I got it. I'm going to try and simplify three concepts in today's videos to make it a high probability trading setup. Do remember, these videos are being made for you, my online family, and your feedback will tell me whether you like it, don't like it, you want me to get more complex, you want me to simplify it even further. So hey, talk to me. Otherwise, I feel I'm talking at a brick wall. Now, in this video, I'm basically trying to filter down stocks, commodities, currencies, or even bonds, any traded instrument traded on any exchange traded platform where you can get open, high, low, close data. You can basically implement this system. It works across time frames, it works across asset classes, and it works in all cycles, bull cycle, bear cycle, etc. Now, what we want to do as capitalists, because we are all capitalists in the stock market or financial markets rather. You want to make the highest amount of money, you want to make it in the shortest possible time, and you want it at the lowest possible risk. That is all of us traders actually desire. That is what we are aiming for. Now, are these criteria to be met via statistical analysis? Yes, they are. I'm a great fan of Dr. Richard Feynman. He said that science, mathematics, statistics should be taught to everyone in simple, easy to understand language so as to make people a lot more rational. Now, I'm going to simplify these three concepts and I'm going to explain it to them along with charts, free charts from tradingview.com as to how you can recharge your trading journey. Number one, what you are seeing on your screen right now is a chart of the Dow Jones Industrial Average, the US Industrial Average. It's the first month future. And what we are seeing is its comparison with natural gas prompt month futures of Henry Hub. Why am I doing that? The analogy is very, very simple. I'm basically trying to see if there is any correlation. As the word correlation tells you, are they moving in unison or are they moving at divergence with each other? Why do you need to know that? Because hey, if at all you want to trade a particular stock on the Indian indices and the Nifty is going up, you want to see which stocks move together with the Nifty and bet that a particular stock that has a very strong correlation with the Nifty, you would go on to that, you would latch on to that, buy some futures, cash, or even call options on it and hope that the correlation coefficient stays and then you make some money. Alternately, you also might want to play contrarian. There are people who like to play contrarian, and if at all then the correlation coefficient is negatively related to each other, which means the Nifty goes up, this stock is going down, so maybe you want to short. No harm, but at least go with the weight of evidence. Instead of shooting arrows in the dark, this study of correlation coefficient is easily available on TradingView as a oscillator. You can try it. In the case of this Dow Jones Industrial Average versus the natural gas futures, the correlation coefficient is minus 0.79, which means both tend to go in opposite directions. So if the Dow Jones is going up, the natural gas prices are going down. Does it have to be a permanent affair? No. As you can see on the chart, it can be plus, it can be minus. So you need to monitor it in real time as to whether the correlation coefficient is positively correlated at this point in time vis-a-vis the past and what is really happening. As usual, whenever there's a change of trend and the price moves from the reading moves from negative correlation to positive correlation, that is when the price makes the biggest move. So watch out for crossovers of the zero mark. Then I would like to add another filter, another study to it, and this is called the average daily range. Why do I want to do that? Because if you're comparing apples with oranges and you basically want to see which one travels further, travels faster, you know how much money to bet. All right. Now here, take a look at these two rubber bands. One is green and the other is orange. At this point in time, both seems to be equally stretched. But what happens when the market turns? And that correlation coefficient chart will tell you that whenever the Nifty makes a turn, does the stock make a turn with the Nifty or against the Nifty? So when one of these are turning, what if there is a unequal change in range? You know how much money to bet. You will bet money on this correlation coefficient on the counter that is making the bigger stretch. Now that can be shown by average daily range. The higher the average daily range, the bigger will be the price move, and that is better for us as traders. You see, we as traders need to put food on the table for our family. You and me are not here to stay relevant. We are here to stay profitable. So talking fancy ideas won't help us. Trading profits, the reality, will help us. And what helps a trader earn trading profits? Statistics. Of course, you might have another system. Go by it. Now, the third study that I want to add is the relative strength comparative. Now, what you've seen is correlation coefficient, which means whether the two securities in comparison are moving against each other or in the same direction. The other was the daily range. How much do they move? Now, the third is relative strength comparative. Here again, it's a free study, and as you can see on the chart, the securities remain the same. It is Dow Jones Industrial Average versus natural gas Henry Hub prompt month futures. What you are seeing is that the reading shows that the relative strength comparative is reading at 0.60, whereas the relative strength comparative moving average is placed at 0.48. A positive reading of relative strength comparative tells you a simple thing. In times of rallies, the security that you're comparing with another is rising higher than the security it is being compared to. And in times of declines, and this is more important, in times of declines, it is falling less than the other security that it is being compared to. So strength, relative strength comes from rising more in bull markets and falling less in bear markets. That is what tells you how much money you should allocate to that particular trade. So now you have these three filters. You have average daily range, you have correlation coefficient, and you have the relative strength comparative. I can add a whole lot more ingredients, just as a chef adds accompaniments, just as a chef adds a lot of garnishing, a lot of additives to make the meal even more spicy, even more juicy, even more tasty. It depends on your level of interest, it depends on your level of understanding, and it depends on your desire to learn. I'm here. Give me a shout in the comment segment. And before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, do let me know what you think of my work and what you'd want me to do next. And a request, please share my videos with like-minded smart traders like yourselves and help me reach out to a wider audience. My work is free. It will always be. I don't provide any services. Thank you for staying with me in this video till we meet again. This is Vijay Bhambwani signing off for now. Have a very profitable trade ahead. Bye-bye.